Today was financials and energy. What would you say about those two areas of the market?
I think the energy one is that if you get the economic slowdown, we know that the oil prices will likely come down. We think that oil prices, the Brent crude, will test 50 once again at some stage this year because of the weakness that we see going into the next year. I think I'm much more worried, Karen, about you're getting some yield there, and we will see a bounce back probably. I'm much more worried about the financials because as we go into this environment where the policy response is lower interest rates, potentially more negative interest rates, then that kills financials. One of our themes is that the systemically important financial institutions, again, are down almost, 28% as a group from that 2018 peak. And a lot of these banks, particularly the European banks, are down 40, 50, 60% from that point. And, I just find it hard to believe that we're going to get a big credit cycle emerging from banks that look that fragile in the equity space. Normally, those equity markets don't tend to lie. And if you've got that kind of impact and that kind of negativity in the equity market, it tells you that something weak is going on underneath. And so I'm very nervous about global financials, and, fixing the financials will end up being one of the key tasks. Indeed, it may be that we don't get through this recession without losing the independence of some of those banks and seeing some bank mergers, particularly in the Eurozone.
Just on that, September wasn't a bad month for Eurozone financials. No. It felt as though a lot of people went bargain hunting because they just looked at the valuations and said, come on, there's got to be a reversion to the mean at some point here. What you do have is a structural shift in the way the central bank is also trying to protect them in terms of net interest margin with this tiering approach to interest rates.
And that's part of the issue about trying to steepen the yield curve as well by driving the short-term interest rates down and encouraging the long-term rates not to come down as much. You're trying to help the banks out there. But, it looks a pretty difficult job from where we are. And, I think what we're concerned about is that if you see some of these dollar-denominated debts and the credit space that the banks have been involved in start to have problems. If economic growth slows, we get default rates going up. So this is even before we've seen a high level of loan losses coming through and default rates increasing. So I'm still very nervous about banks. They're one of our underweight sectors. Bargain hunting, Jeff, we see a lot of people talking about, a lot of people want to get into value stocks at the current time. And we just say, keep it simple. In economic downturns, bond yields come down, defensives outperform, and defensive valuations get more expensive.
We have seen that with the last couple of sessions. Real estate and utilities are the two outperforming sectors on Wall Street in the last two sessions. Ian, thank you very much for staying with us, our guest host today. We are counting you down to the European session, about 30 plus minutes to go. The early signals for FTSE futures and CAC futures are just a little bit weak, not so much on the French market, but you can see about 4/10s down on FTSE futures, which would reinforce some of the selling we've seen in the last session or so.
Right now on CNBC Make It. Think you've had tough...
You're in charge of hiring, and Indeed has solutions, like online skills tests, which let a candidate show that they are the right hire. And we give you this toy monkey, who will bang its cymbals when the right CV appears on your desktop. Okay, there is no monkey. There is no monkey. But there are online skills tests.
See why more than 250,000 companies in the UK use Indeed for hiring. Visit Indeed.com/try today to try skills tests for free today. Terms and conditions apply.
We could play epic music, or we could speak in an overdramatic tone, or even set off fireworks. But that's just not smarty. Instead, we let our offer do the talking. Right now, you can grab 25% off our unlimited data SIM. That's just $18.75 a month with no speed restrictions, no credit check, and no long contract to tie you in. Now that's smarty. Just search Smarty Mobile and switch today. It's easy. Offer available for a limited time only. See smarty.co.uk for terms.
Get ready for Brexit on the 31st of October. Find out what you need to do to prepare at gov.uk/Brexit.
The relaxing sound of fresh, cold running water. And you can have it in your kitchen. With amazing savings on Samsung fridge freezers at Currys PC World. Like the RB31 with its chilled water dispenser for only $399. Or upgrade to the Samsung RS8000 American-style fridge freezer with water and ice dispenser. A huge 609 litres of storage space. at just $104.9. How relaxing at Currys PC World. Energy rating A+. T's and C's apply.
At Argos, save 25% off homewares across thousands of lines. Our autumn-winter home and furniture collection is here. So stylish, you can wear it. With Argos, you're good to go. Offer ends 8th of October. Conditions apply. Subject to availability. Selected lines.
The biggest cat in the world was longer than a cricket bat. Think that's big?
This Friday's Euro Millions jackpot is an unmissable £169 million. 169 million! Now that's big!
Euro Millions from the National Lottery. Amazing starts here.
Estimated jackpot is capped at €190 million. Rules and procedures apply. Players must be 16 or over.
Welcome to Sport Box. If you are just joining us, here are your headlines. The US hits the EU with tariffs, widening the trade war after the WTO gives Washington the right to put levies on $7.5 billion worth of European goods in a long-awaited case.
All of those countries were ripping off the United States for many years. They know that I'm wise to it. We've had a lot of wins. This was a $7 billion win. Not bad.
European futures point to a lower open after Wall Street logs its biggest one-day decline in nearly 6 weeks, as trade tensions and weaker-than-expected jobs data in the US fuel growth worries. UK Prime Minister Boris Johnson makes his final Brexit pitch, offering a compromise on the contentious Irish backstop, but the proposal receives a tepid response from Brussels.
There is progress, but to be frank, a lot of work still need to be done to reach and to fulfill the 3 objectives of the backstop.
Retail giant H&M posts its first quarterly pre-tax profit rise in 2 years, thanks to a summer sales boost and growing market share. Investors have had a lot of issues on their plate to digest, and one more tallied up yesterday, the $7.5 billion worth of tariffs on European Union products in retaliation for subsidies on Airbus, this after a ruling from the WTO. So investors are rocked. In addition to what we've seen from the tariff side and the rhetoric, no real progress to report much on China yet. Investors still waiting to see, but an escalation against a major partner. At the same time, there's been an impact. There has been a cost for Americans. And we've seen it in some of the data, the manufacturing index that rocked confidence early in the week, the ISM numbers showing the lowest pace in more than a decade. That's now being reinforced by some other data points. And yesterday, it was the private payrolls number that came through soggy. 135,000 jobs created in September. That was a slowdown from 157,000 the previous month. And that number, too, also revised lower. So investors just taking stock and questioning the impact on workers, which ultimately could have an impact on Main Street that has not flashed red signals just yet. So investors are pulling stocks to the lowest point that we've seen since about August. The reversal now from some of the highs. It's still not a huge percentage drop from peak to the low point we're now on markets. Less than 5% on the Dow and the S&P, less than 7% on the NASDAQ. So in context, we're still traveling around some of the high ranges. However, it was the swift retreat and on volume yesterday that investors have paid attention to. Asian markets in this context, China out of action, so some liquidity impacted. We're not seeing an impact on that market where naturally may have seen some trade reaction. But the other markets, Japan, very weak today, 400 plus points, lower or 2%. Very soggy session too for Australia, more than 2% in the red, slightly more contained for the other major markets. European markets, as they get set up for trade, also reeling from a very negative session that played out on the continent yesterday. We were down 2.7%, the worst day of 2019 for European stock markets. Purely now, if you take a look at the UK market for the FTSE 100, the worst day since January 2016 played out, and we've got another 1/3% expected to come off the major market. Flat for French stocks, and perhaps that is a reaction to what Charlotte was telling us earlier, that it could have been worse for some of those French producers on the back of the tariffs.
Karen, thank you very much. 33 minutes into the hour, and you've got to hear about Brexit. A compromise, that's what British Prime Minister Boris Johnson is calling his new Brexit proposal, which he laid out in a 4-page letter to the EU. The plan gets rid of the backstop and replaces it with an all-Ireland regulatory zone and electronic customs checks away from the border. The EU's chief Brexit negotiator, Michel Barnier, suggested the PM's proposal is a work in progress, but Guy Verhofstadt, the head of the European Parliament's Brexit steering group, took a stronger line on the new plan.
First reaction in the Brexit steering group was not positive. Not positive in the sense that we don't think that this is really the safeguard that Ireland's need. But
well, within the last half hour, the UK's Brexit Secretary, Steve Barclay, has stressed the government is serious about its latest proposal, adding it's the only way to get the Brexit deal done. Let's go out to Willem in Brussels. Well, I don't think anybody is going to be that surprised by Guy Verhofstadt's reaction, given his track record through these negotiations, Willem. But the UK government wants to imply, I think, that there is a more serious moment in this negotiation and that actually maybe there are some grounds for compromise. Perhaps we can talk about the mood and the reality.
Yeah, Jeff, clearly the seriousness in some extent comes from the timetable. We're very, very close to that deadline. To talk about this in a bit more detail, I'm joined by Peter Klepper. He runs the Brussels office here for the think tank Open Europe. Let me just ask you first off to try and explain what exactly this proposal that we saw from the British government is.
Well, the UK has made a big concession. It has said that it is now willing that Northern Ireland follows EU regulations when it comes to agriculture and manufacturing. So as a result of this, you would not need regulatory checks between Ireland and Northern Ireland, but you would need such checks between Northern Ireland and the rest of the UK. Secondly, Boris Johnson has said that he wants Northern Ireland to remain in the UK's customs union. Of course, as a result of this, at some point you would need customs checks between Northern Ireland and the Irish Republic. And the Irish are suspicious that it may be very hard to avoid a hard border if you have such checks.
Let's talk about those checks then, because you mentioned the Irish. What about the Commission? What would your expected response be from them once they look at these proposals and look at the details being offered by the UK?
Well, the EU has been they have been reserving judgment, and today there will be more investigation into the proposals. Now the Commission has said it's fine, we can look at such alternative arrangements, but they need to avoid a hard border. Now what the UK wants to do is to achieve this by checking goods at company premises, so to avoid customs posts and things like that. But of course, this would require exemptions from EU law. It's possible legally, but the EU would have to be flexible. And also, it would require that small traders are not being checked. That's a UK demand, and so far the EU has refused to agree with that.
It sounds like it's the EU being a bit intransigent about some of these issues. Is that really a reflection of your thinking?
I do think so, because if you look at the EU's external customs and regulatory border, this is by no means perfect. There are many holes in that particular border, so you could wonder, okay, why then not be flexible when it comes to the Irish border as well, for the sake of peace?
Do you think that the unity amongst European member states we've seen so far during this process, particularly when it comes to Ireland's position, can hold if they feel that the UK is indeed serious about no deal at the end of the month?
Well, I think it will hold as long as the Irish are reasonable. To be fair, the Irish have been flexible to a certain degree, but I think they will have to go further. Also, the other EU countries will have to go further. I mean, remember, they are the ones that will be asking Ireland to protect their border. It's actually not the UK that is so keen on border checks. It's more Belgium, the Netherlands, France, Germany. So they will have to show some flexibility there. And at the moment, the Irish have said, look, you can't ask us to trust the British, and that's fair enough. But then if there is no trust, surely why are the Irish asking the British to trust them, that the Irish won't be dismissing all suggestions for alternative arrangements at the border?
So the challenge for the UK is to have Northern Ireland part of the United Kingdom, and yet this proposal, from my understanding of it, create some kind of barrier between Northern Ireland and the rest of Great Britain, doesn't it?
That is true, but it's not the end of the world, at least not in the words of Boris Johnson. He quotes DUP leader Ian Paisley, who said, our people may be British, but our cows are Irish. At the moment, you already have some checks when it comes to live animals between Northern Ireland and Great Britain. So it's just about expanding that to a degree. However, to put a customs border inside UK territory, that's a big ask, and it's not just in the Conservative Party that people are uneasy about this. So I think it's politically realistic for Boris Johnson to say, look, you're going to have to accept that Northern Ireland is remaining part of the UK's customs union.
Peter, we'll leave it there. Thank you so much for coming and joining us here outside the European Commission this morning. And as you heard there, guys, you know, a bit of flexibility from the Johnson government, and what Peter there is calling for perhaps is a bit more flexibility from the Europeans as well.
Willem, thank you very much for bringing us that story and terrific interview. Meantime, President Trump has lashed out at House Democrats over the impeachment inquiry, saying his political rivals are pursuing a, quote, hoax. The US president tweeted that Democrats were wasting everyone's time and energy. He also reiterated claims that a phone call with Ukrainian president was perfect. However, the president said he would comply with investigators as Democratic-led congressional committees threatened to subpoena the White House.
I always cooperate. This is a hoax. This is the greatest hoax. This is just a continuation of what's been playing out, John, for the last, since my election, I would say, if you want to. Probably, we'll find out soon, but probably even before my election. This is a fraudulent crime on the American people, but we'll work together with Shifty Shift and Pelosi and all of them, and we'll see what happens, because we did absolutely. I had a great call with the president of Ukraine.
Well, there you go. There's President Trump. We just cut him off there. But let's move on and find out what the Russian president had to say about this. Vladimir Putin backing up President Trump, saying he saw no evidence of wrongdoing by the US president. In an exclusive on-stage panel hosted by NBC News, the Russian president also joked about Moscow potentially interfering in the 2020 US presidential election.
I'll tell you in a secret, yes, we will definitely intervene. It's a secret, so that everybody can laugh, and so we'll go big, but don't tell anyone, please.
Putin and a number of top executives and ministers from the energy industry, including the CEO of BP, Bob Dudley, and OPEC Secretary General Mohammed Barkindo, also addressed the recent attacks on Saudi oil facilities. The Russian president claimed there was no proof Iran was behind the hits, while others praised Saudi Arabia's response.
We're against shirking the blame upon Iran, because there are no real proofs behind that. And yesterday we spoke about that with President Rouhani.
There's something about the speed of information today around the world, the quickness of which the response by Saudi Aramco, the storage levels around the world. Everyone knows really what they are, the potential supplies.
I cannot think of any such a monumental feat of ingenuity of a people who are faced with that crisis to be able to respond so swiftly.
If you had told me, I think the rest of the industry, that we'd have that kind of attack and loss of production capacity, the markets would have responded as calmly as they did, I think we'd all have doubted that.
So this is a major set-piece event in Russia, Russia Energy Week, and as you saw on stage, some very significant members of the energy community. What is it doing to the oil price? I think it's worth just having a look here to see whether they're providing any support at this point for WTI, and it does appear that all the talking, all the jawboning is putting some support behind the crude price. $52.70 is where we currently sit on this quote. Speaking on stage earlier at the event, the Saudi energy minister, Prince Abdulaziz bin Salman, said Saudi Aramco had shown its resilience following the recent attacks. He also stressed the need for OPEC and non-OPEC countries to work together.
We're, yes, concerned about our own interest and the stability of our market and stability of the world economy, but also we are mindful of our responsibilities towards the consumers. So it is an alliance that can bring perpetual stability to the oil market.
Let's get back to Ian Harnett then, co-founder and chief investment strategist of Absolute Strategy Research. As a historian of markets, you'll know that quite often when we get recessions, the oil price plays a key role and rises often into the beginnings of a recession here. But $50 a barrel is not going to be stress on the consumer at this point.
No, it's not. And actually, I think one of the things that we would want to see to try and get us out of it, and one of the things that happened in 2015 and also 1986, was that oil prices came down, and that was enough of an implicit tax cut to get us out again. So I think it'll be very interesting to see what happens. It looks as though this time our sense is that there's enough excess supply, as you say in your piece. Normally you would have expected to see much more of a ramp up in the oil price given that kind of geopolitical tension. The fact that everybody knows that there is that US supply coming in on top, anytime we get that push up in prices, I think is going to moderate the price this time. And indeed, we would argue that the risk is that oil prices come down. So unlike those previous occasions where it was actually the rise in the oil price that was one of the things that helped to trigger the recessions, I think this time is going to be much more about monetary policy and about trade per se.
Classically, you would avoid this sector if we are going into recession because it sits with other commodities that are likely to be impacted. And yet these companies have shown capex discipline. They're generating good yields, and the managements seem conservatively focused. What's not to like?
Yeah, well, I think that there is, but I think there's just the aversion. They are still cyclical stocks, they are still value stocks, and if the oil price does get dragged down by weaker economic activity and that potential excess supply because of the US ability to provide overhang, that actually limits. You need to see a bigger discount now or a bigger dividend premium, I think, to really get in. And we come back to the story, which is that it's only once you've seen the interest rate cuts and you can start to see the potential for demand to pick up, but then these will just rocket because of that kind of supply discipline, Jeff.
That's the big if, though. If you see a drag down in the oil price, what if there is a trade resolution that comes out of nowhere? We've seen enormous pressure now globally on the US economy, growing fears and pressure arguably on Donald Trump to get a deal done with China. It may not be the deal everybody wants, but what if there is pen to paper on a resolution that improves investor confidence and business gets going again? Doesn't that take out some of the calls on oil price?
It takes out some of the downside risk, I think, Karen. But, if you know that there's going to be a trade deal, I know there's got to be a trade deal. The Chinese know that there's going to be a trade deal. It's a bit like Brexit. So where's the incentive for that trade deal to be done early? Even though President Trump will tell us it's the biggest, winningest deal that's ever been done, it is going to be on China's terms, both in terms of timing and whether they perhaps don't necessarily want to see a new President Trump administration, or, and on their terms in terms of what it actually encompasses as well. So I think the initial response to any trade deal is going to be positive, but I think then we'll actually take a closer look and say, really, does it change the dynamics for the global economy? I
just want to unpick that comment you made there about China and its timing around a trade war. I think that's fascinating because what we've seen so far, a narrative from the White House that President Trump is not ready to get a deal done at this point, which gives us the impression that he's deciding when the trade deal happens for his own purposes and whether he's got enough detail or enough wins tallied up. You're saying the Chinese might play politics on this to try and keep him out of the White House?
I think it's like Prime Minister Johnson and the Europeans, which is that Prime Minister Johnson can say that he's made all the adjustments, but actually it's Europe that's going to determine the outcome here, and the Chinese will be the determinants of any trade deal, and I think that is the reality. And in the meantime, the collateral damage is the Asian export markets, where we're seeing a lot of stress, and that Asian economy being very weak. And remember that there are two challenges here, because the global trade model has been built around Asia and about China and Asian trade and long, thin supply chains. The financial model is around the dollar. And, what we're seeing is the challenge of those two models working out. And, perhaps Hong Kong and some of the stresses we're seeing there is the collateral damage.
Great discussion. Thank you very much for that. We're going to squeeze in a quick break. Coming up on the show, Tesla deliveries hit a record in the third quarter, but fall shy of forecasts, sending shares sliding in after hours. Details on that story coming away next.
The relaxing sound of fresh, cold running water. And you can have it in your kitchen. With amazing savings on Samsung fridge freezers at Currys PC World. Like the RB31 with its chilled water dispenser for only $3.99. Or upgrade to the Samsung RS8000 American-style fridge freezer with water and ice dispenser. A huge 609 litres of storage space. At just $104.9. How relaxing. At Currys PC World. Energy rating A+. T's and C's apply.
At Argos, save 25% off homewares across thousands of lines. Our autumn-winter home and furniture collection is here. So stylish, you can wear it. With Argos, you're good to go. Offer ends 8th of October. Conditions apply. Subject to availability. Selected lines.
Get ready for Brexit on the 31st of October. This means that travelling to the EU will change. You'll need to check online if your passport is valid for travel to Europe. If you're planning on driving, you'll need to check if you have the right documents to drive. And make sure your travel insurance covers all your healthcare needs. To keep your trip on track, check what you need to do at gov.uk/Brexit. Get ready for Brexit on the 31st of October.
The relaxing sound of fresh, cold running water. And you can have it in your kitchen. With amazing savings on Samsung fridge freezers at Currys PC World. Like the RB31 with its chilled water dispenser for only $3.99. Or upgrade to the Samsung RS8000 American-style fridge freezer with water and ice dispenser. A huge 609 litres of storage space. At just $104.9. How relaxing. At Currys PC World. Energy rating A+. T's and C's apply.
TuneIn puts you on the sideline for the 2019 college football season free all year long. With college football on TuneIn, hear the home and away call for more than 140 schools live, regular season matchups and rivalry games, conference championships and bowl games, the college football playoff.
Throw it. He's got it on stiff arm. End zone. Touchdown.
You can listen to it all for free at home, on campus, or on the road. Hear the excitement and pageantry of college football all season long, free on TuneIn.
From the TuneIn Studios, I'm Fonseca with your daily sports update. NFL lives right here on TuneIn, and if you're not following your favorite team, you got to do it today. NFL action, well, is going to be live here, home and away calls this Thursday. We've got the Los Angeles Rams at the Seattle Seahawks.
They got all kinds of firepower. They're loaded, and it's going to be a great matchup. It's going to take everything. It's a game we need to play. We need to be involved in games like this if you're going to have a good season.
Kickoff for that game is going to be 8:20 p.m. Eastern right here on TuneIn. That's your TuneIn Sports Update.
Tesla shares fell more than 4% in extended hours trading after the electric car maker reported third quarter deliveries just below analyst expectations. The company delivered around 97,000 vehicles during the period, despite suggestions from CEO Elon Musk that the company had, quote, a shot to deliver 100,000 cars. But Tesla said it had posted record new orders and was seeing strong organic demand.
Policy executives from the consortium behind Facebook's controversial cryptocurrency project will attend a meeting in Washington, D.C. today. That's after the tech giant's top Libra executive denied reports that key founding members were wavering in their support amid scrutiny from regulators. Elizabeth joins us round the desk. Libra appears to be stuck in neutral at the moment. Any evidence that after the meeting today, we might get some more buy-in?
They are certainly trying to get it out of that neutral gear and move it forward. And that's what it looks like. This is kind of trying to forward the process of how to get the member companies, more than just on board in theory here. So to join the Libra Association, this is the consortium that's overseeing this proposed new digital currency called Libra. You had to commit $10 million to be part of it. But what we've heard is that that's sort of, that's all that's been done at this point. In October 14th, so later this month, after this DC meeting, the members will be meeting in Geneva, and we've confirmed from several member companies that they'll be attending that meeting. What's likely to happen there is a vote on the board of the Libra Association, as well as a ratification of this charter. So that would be the step that's required to kind of take this out of that just original commitment and move it forward. Now, that's all good. But there's this whole issue of what the regulators are saying, which is that they don't want this project to move forward until they're absolutely sure that Facebook has Facebook and the Libra Association have complied with existing regulations. And we've heard not just from the Swiss regulator, which is technically the regulator overseeing this project in Switzerland, as well as the U.S. Regulator on the financial side. We've heard this from politicians. We've heard it from policymakers, finance ministers. This has really been a broad-based pushback. So there seems to be a good amount of hurdles that still need to be overcome from those regulators all around the world before that next step is taken.
It's a tough one for the likes of Visa and MasterCard to try and navigate, because clearly going after new revenue sources, and this has potential high volume, you can clip the ticket on it. However, the risks on the other side around know your client, and if you think about a credit card that's issued, they have very strong identity around that credit card. But with a Facebook account, it could be anyone. It could be anyone this day, anyone the next day, and the day after.
This is one of the issues that the regulators are facing here. I think they're very concerned about the privatisation of monetary policy. It almost takes us back to the pre-1640 times, where pre-Bank of England were issuing currency and everybody issued their own currency. So I think the initiative from Mark Carney to introduce a central bank cryptocurrency, I do think the BIS have been doing a lot of preparatory work around this area. I think we've heard that from Mark Carney. There are very good reasons why, particularly at zero and negative interest rates, you'd want to use a cryptocurrency rather than using cash. You can't stuff that under the mattress. So I think there's a lot of reasons why regulators and policymakers will want to slow down Libra and actually put something in place first.
But interestingly, we actually heard overnight that the House Financial Services Committee has asked the Fed to look into creating its own digital currency. So if anything, what this Libra initiative has done is brought this to the forefront for regulators. They've said, it looks like this is something that's on the horizon, whether it's coming from a company or from ourselves, and it's certainly escalated that conversation.
Yeah, and I think that, and it's, as you say, Elizabeth, it's definitely going to be there, and I think the central banks say, right, we've got to own this process, because otherwise we will have this private sector currency, and how do you manage monetary policy in that kind of environment? And I think that's the challenge that they face.
Do you think that, currently the central banks have swap lines that are organised and they transact with. Do you think if we move to something like that, that would relieve some anxiety in markets about potential liquidity issues?
I think the problem is we don't know. Then you come back to the stability of the organisation behind Libra, or whatever the new currency, cryptocurrency might be on the private sector. How do you choose which currency gets acceptance? So there'll be a whole range of issues. I think for the central bank perspective, effectively, they're just transferring digital codes at the moment. This is no different. But extending it from the central bank actions to the rest of the private sector.
Thank you very much, Elizabeth. Thank you for the report. We are counting you down to the start of the European session. Stay tuned after that sell-off on Wall Street. How will European markets react?
You're in charge of hiring, and Indeed has solutions, like online skills tests, which let a candidate show that they are the right hire. And we give you this toy monkey, who will bang its cymbals when the right CV appears on your desktop. Okay, there is no monkey. There is no monkey. But there are online skills tests.
See why more than 250,000 companies in the UK use Indeed for hiring. Visit Indeed.com/try today to try skills tests for free today. Terms and conditions apply.
Get ready for Brexit on the 31st of October. This means that travelling to the EU will change. You'll need to check online if your passport is valid for travel to Europe. If you're planning on driving, you'll need to check if you have the right documents to drive. And make sure your travel insurance covers all your healthcare needs. To keep your trip on track, check what you need to do at gov.uk/Brexit. Get ready for Brexit on the 31st of October.
The biggest cat in the world was longer than a cricket bat. Think that's big? This Friday's Euro Millions jackpot is an unmissable £169 million. 169 million! Now that's big!
Euro Millions from the National Lottery. Amazing starts here.
Estimated jackpot is capped at €190 million. Rules and procedures apply. Players must be 16 or over.
The relaxing sound of fresh, cold running water. and you can have it in your kitchen. With amazing savings on Samsung fridge freezers at Currys PC World, like the RB31 with its chilled water dispenser for only $399. Or upgrade to the Samsung RS8000 American-style fridge freezer with water and ice dispenser. A huge 609 litres of storage space at just $1,049. How relaxing. At Currys PC World. Energy rating A+. T's and C's apply.
College football is live on TuneIn. Listen for free to games from more than 140 schools all season long.
To the 10, all the way to the checkerboard. But he stays on his feet and scores.
What's happening in college football this week, this Saturday? The scoreboard will be working overtime as Sam Ellinger brings his vaunted Texas Longhorns passing attack to West Virginia for a Big 12 conference matchup against the Mountaineers. The action starts at 3:30 p.m. Eastern. Just search college to listen today.
Deep left center field. A grand slam!
October baseball is here, and TuneIn Premium is your ticket to the 2019 MLB postseason. Featuring the home and away feeds for every game, TuneIn Premium delivers every call of the ALCS, NLCS, and the 2019 World Series through the voices of the local radio broadcast teams.
Air left fielded deep. He's at the wall.
Now until a new champion is crowned, hear every play of the 2019 MLB postseason live on TuneIn Premium. Upgrade today.
Seeing the early stages of the European market open. A slightly different mall this morning for our keen-eyed viewers out there because Germany is out of action today, not trading as it is shut. But we are getting some instant reaction to the latest selling that we saw on Wall Street yesterday. Very weak session taking us back to August levels, and the market reacting very swiftly to fresh tariffs that have been tallied up by the White House. $7.5 billion worth of goods from the European Union to be targeted, and a retaliatory strike for Airbus subsidies. But a whole range of different industries and products, not just industrial, in reaction to that Airbus story, but around food and agriculture, beverage, so wide-ranging. And this is how it is playing out across on markets. The FTSE, a very curious one. Don't forget we had 7,400 on the index just recently. We've managed to unwind right back to the 7,100 level, and even that looks like it's in doubt. Yesterday, the UK stock market had its worst trading day since January 2016, so very steep falls on the stock market. It's been down for 3 consecutive trading sessions, so if it closes out today in the red, that will be 4. And so far this morning, another modest move south on the boards is what we are witnessing. Of the other key markets, it's also a weekday playing out for the Italian stock market. We did see some early green suggesting that maybe it might be a little bit more immune, but 11 or 9, 10, 11 roughly points just coming off the index as it tilts lower. The others, we've got the IBEX just trying to move into positive territory, along with what we're seeing across on some of the other core markets in France. The SMI looks like it's yesterday's numbers so far. Just a little bit cautious around that. But it was a very weak session that played out across Europe yesterday. So some of it was actually in the price that we saw. The Stockstrip 600, for instance, down 2.7%. It was its worst trading day for 2019. So investors taking stock in session on this side of the pond yesterday. And you are seeing just a little bit more come into the numbers today. Let's push on and take a look at what we're seeing for the FTSE, and it plays out by individual stock levels. And you can see as we peel back by about 0.1%, bulk of stocks in negative territory. A couple of insurers in negative territory at the bottom here, including some travel companies. Next, retailer Barclays in the banking space down 1.3%, and just a small patch of green, including Prudential, BT, HSBC, Burberry, actually a strong trade this morning in the luxury space. In case you missed it, the US government has announced it will impose tariffs on up to $7.5 billion worth of EU exports. The move comes after the WTO found the US was entitled to retaliate against the EU's subsidies to Airbus. The question is what happens next and whether there is retaliatory moves as WTO also rakes over subsidies given to Boeing on the other side. So we are in a space of tit for tat potentially on some of these tariffs. Airbus itself rallying 3.8% in the early stages. The new levies include a 10% tariff on European aircraft, a 25% duty on some agricultural products, and another 25% hike on French wine and Scotch and Irish whiskey. The airline stocks that you can see this morning, patchy, Ryanair weaker, along with Air France and IAG, the owner of British Airways. Food and drink space, look at some of the early reaction. Don't forget some of the small producers impacted here, but these are the big names. And we're having a conversation this morning with an expert in this space around tariffs, saying some of the big ones can probably weather the storm a little bit better than those smaller producers dotted across Europe. And you can see on the big ones, Diageo stronger, 1.6% in the green. Luxury, I mentioned Burberry had quite a bid this morning, and this is how it plays out for the rest of the stocks in the space. LVMH, one of the big ones in France. I'm sure you all know the logos by now. 1.4% in the green, along with Kering, the owner of Gucci, faring nicely this morning. Just a little bit patchy around Essilor Luxottica, the eyewear maker. That one's showing just a little bit of a tentative trade this morning, along with Swatch. But elsewhere, firmer trade. And Charlotte is here to explain why. Jeff, so let me toss it back to you.
You know what? Can you hear that, Karen? It's the sound of a big Gallic shrug. Right?
My clip-clopping shoes across the
No, not your clip-clopping shoes. I could hear those too.
French shoes.
But Charlotte has joined us, who covers everything French for us here at CNBC, as you know. And you and I were just talking off-air about the remarkable rebound that we're seeing in Airbus this morning. But look, everybody's looking at these tariffs and the share prices are higher. What's going on?
It's a relief for all of them. You know, those stocks went down quite heavily yesterday. It was an overall market trend, but also when the announcement came out from the WTO. But then the list was published of the products that would actually be affected. And for French companies, it's actually pretty good news. Starting with Airbus, the main point here is that the tariffs would be 10% on Airbus planes rather than 100% that Boeing was asking for. So that would have made a massive impact for those American companies that have ordered Airbus planes and committed to buy them. And also then wouldn't buy more Airbus planes because not economically effective for them. So in the future, no more orders for Airbus. And also an important element is the aircraft parts are not on the tariff list. And that's incredibly important because in Alabama, Airbus has a final assembly line where they put together the A320neo, which is their cash cow, and the main competitor to the Boeing 737 MAX. And there will be no disruption to that assembly line because parts are not under the tariffs because they import about 60% of the parts for that plane, for that factory. So great relief here for Airbus. There won't be disruptions there. And then for those luxury stocks that we've just seen, leather goods are not on the list of tariffs. So good news for those Hermes bags, Gucci bags, as you mentioned, etc. There won't be tariffs on them yet.
So Melania Trump's wardrobe is safe at this point.
Maybe she had a bit of influence there. And champagne is not on the list, or French cheese is not on the list. So things that would have really hurt the French economy and French companies are not there. Wine is the main one that will be impacted here, and the US is the main market for French wine export. It is number one market for them. It's the second largest export for the French economy, behind, you guessed it, aeronautics, aerospace industry. So this could have an impact. It's 1.7 billion euros of wine exports from France to the US. So it's a sector that is struggling in France, has an important political and economic impact and influence in France. But overall, for the French stocks, as we've seen, there's a relief because the list of tariffs is actually not that bad.
Okay, hang out with us for a bit longer. Ben Jones has joined us, senior multi-asset strategist at State Street Global Markets. Ben, is a relief rally that you chase the right response for the markets on this trade story?
I think so at the moment, yeah. I mean, we've been seeing a lot of these dips over the last sort of 6 months or so, and they've always been buying opportunities. And I think they've always been buying opportunities because we know that central banks are going to stand behind them. We know that liquidity is coming into the market. We know that rates are going to stay very, very low now for a very long period of time. Now, that does absolutely nothing for me for the real economy. I don't think that helps the consumer. I don't think that helps businesses. But businesses and consumers aren't struggling with high debt costs right now. But what it does mean is there's a lot of money chasing fewer and fewer assets. So equities do relatively well. Things like gold do relatively well in this environment. And I think in terms of the comments that you were just making there, I think it's absolutely key that the threat of tariffs hanging over Europe is not a new story. We've been worried about this for 18 months, 2 years or so. The numbers that we're talking about, though, are much, much smaller than we expected and hitting a narrower range of business than we expected.
So Ian here would have us sell into the rallies and not buy the dips. What is he not seeing that you see?
I think it's just the fact that there's a lot of liquidity in the market and central banks are standing behind it. I mean, ultimately, I think we're probably actually slightly both right, because we've been in this sort of trading range for the last sort of year or so. So you sort of you sell it right at the top and you buy right at the bottom, and you stay in that kind of area.
The thing that I would point out is that, whilst I think there's something called dollar illusion, which is, whilst in local currency, some of these markets look fine, in terms of the dollar ability to buy, you've been losing out every time. So, that's why global equities and world ex-US, you've seen those equity returns really trashed over the last 18 months and very aggressively. I think the thing that I worry about is that when we see the inflection point in markets, when unemployment starts to go up, that's the point where you start to see the acceleration of the equity decline relative to bonds that I'd be nervous about for Ben, partly because we're already seeing Europe's most cyclical economy, Sweden, the unemployment rate suddenly gone from 6% up to 7.5% in 3 or 4 months, and that's tended to lead the Eurozone, Germany. But France is going to be the most defensive. It's one of the most defensive markets. It's got a very nice spread of economic variables and economic activity, and it's also done a lot of the debt. So the big risk for France is actually it's originated 50% of Eurozone's debt over the last 5 years. That's its weak spot.
Just stepping down from the macro a little bit with this trade story, there is a risk ultimately in the numbers and the profit numbers from companies that you get some lumpy numbers by region. I mean, for the big companies we're talking about around luxury and also around food and drink, if there is an effect where there's less demand from one place, say the United States, you can see some of these producers sending more product where there is demand to, say, the Asian region, and wine, spirits, beverages, that jumps out quite dramatically. There's always been very strong demand from the Asian region. They just haven't fulfilled it as much because they're mindful about having diversification across their portfolio and fulfilling the orders from American customers. But if American customers are not stepping up and taking the product, you've got to wonder whether that product is just redirected in this window of time, which means lumpiness by region. So how would you sort of weigh up that? Because it comes back to whether that Chinese or Asian consumer or even a Middle East consumer is strong enough to pick up on some of that demand.
I think so. I mean, you're right. I mean, I think it's lumpy in terms of geography. It's lumpy in terms of sector as well. And although I'm generally pretty positive, I see an awful lot of differentiation across the world. And I'm still very much more positive on the service sector of the economy, particularly sort of the tech service sector in the US. But actually, the luxury goods area is something that we've liked for a long period of time. We know it's already done very, very well. But it's still that very high quality part of the market. Yes, it's very high end goods, but actually they're relatively price insensitive. So some of these tariffs won't necessarily be a big issue. And for me, the big growth story still is the Chinese consumer, and particularly those millennials that are now coming on stream that have a very, very different savings ratio to their parents. They're not big savers. They are big, big spenders. And you're seeing debt rising among that cohort at the moment. So I think the Chinese consumer can come in and step up. And you're seeing it from LVMH and Kering. That's where the growth is right now. I think that will continue.
I think my only concern about that whole story, and Karen, your point, is how quickly can you change those supply chains, to meet that demand? And, in the interim, do you end up having to do a bit of stockpile? And if you build those inventories because you're losing out in America and you haven't yet really built up the demand side on in China or the Middle East, if you're stuck with those inventories, and that's when you cut back your production domestically. And that's one of the things that fuels the slowdown.
Yeah, and I think you're right. That's the key point, is that, of course, the potential in Asia is there. And they say medium term, long term, the Chinese middle class is growing. The appetite for those luxury goods is going to grow as well. But short term, you have the Hong Kong protests that have been a massive hit on those luxury companies. In China, the economy is slowing down. That can have also an impact. Trade war affecting consumer sentiment. There's all these short elements that in the short, medium term can affect these luxury stocks, even though long term, they know that the potential is there.
Just on Hong Kong, I've seen a lot of people who are trying to plan out where this story goes next, and they argue that now we're through China's big celebration, Xi can get rough with Hong Kong and there will be no consequences. But of course there are capital flight issues from that quite sizable economy in global terms. Do you think there's a risk of this? What do you think, Ben?
I think so, yes. I think you can see clearly that confidence in Hong Kong has been shaken, and obviously we know that market is very much dominated by financials and real estate, two sectors that are most sensitive to sentiment and to confidence. And yes, I think we are starting to see that capital flight from that region at the moment. We're already seeing the southbound flows that are coming in from Chinese investors into the Hong Kong market. They were very strong through the beginning of the year. They're now starting to dry up. So it's not just investors outside of the Asian region, it's Chinese investors as well that is stopping putting money into that area. If you were a company now thinking of putting your headquarters or people into Hong Kong, I think you'd be looking very, very serious and thinking, do I want to go to Hong Kong or do I go to somewhere like Singapore, for example?
Does the PLA cracking heads in Hong Kong rule out a trade deal with the United States?
That I don't know, but I think what we can see is that, you have this parallel between what happens in the trade space and what happens in capital markets. And I think what we worry about is that if we see the intensification of trade wars, then we're going to see capital account restraints. We actually saw some of the opening salvos from the US last week on talking about limits to Chinese companies, and Chinese investment. I think we worry that the fulcrum around which all of these will resolve is Hong Kong. And, our big risk, if we do get a bigger slowdown, is that eventually you will end up with the Hong Kong peg breaking either actively because China says we don't want to borrow America's monetary policy anymore, and we don't need this outlet, or, the frictions just get too great, Jeff.
The planning by Chinese authorities. There was sort of a push, obviously, to have a NASDAQ type of exchange in that part of the world to try and get some of the tech companies listed on a local exchange. At the same time, just a week or so later, you hear that maybe Chinese companies won't be welcome to list in the United States. I mean, that was sort of put out there then denied, and we've seen a few of those types of stories, enough so that we have to pay heed to whether there is any potential for it. Yep. What would the impact be if you see much more closed capital markets and the Chinese not taking big listings to the States like we've seen the BATs, for instance, in recent years, Alibaba? What if that were just simply to disappear and Chinese companies stayed in China?
I think that would be huge. I mean, the kind of numbers that we're talking about on the capital account compared to the trade story are just, there's a gulf of difference between them. It's enormous. So at the moment, I think we need to be very careful and watch how this plays out and get try to get some more solid news on this. But if it does come to pass, if kind of the tweets and the comments that we saw from Trump last week are a sign of things to come, then that is a major risk factor. And that's an environment where I do shift to far more bearish view than I'm sitting at the moment. I don't see that as being the base case, because I think Trump wants to be elected in 2020. I think we've got to keep this in mind, that Trump needs a decent S&P next year and Trump needs a reasonably decent
Isn't it going to be
economy.
Impeached? Is he still going to be there?
Who knows? But I think actually the impeachment kind of plays to Trump, to be honest with you. I think he can play this quite nicely and say, look, this is the Democrats fighting against me, this is the establishment fighting against me, and that will play very well to his solid sort of voting base. So I don't see it as a big threat.
That's one of the dangers, which is because he is such a maverick. Normally if economic growth is slowing and unemployment is going up, you say, all right, the president's going to lose. But actually, he may just intensify these trade wars, intensify that narrative, and we really don't know how that's going to play out this time. So I think it's dangerous to make those big bets based on the political outcome alone.
Okay, let's a quick update on some economic data here, because the market very much sensitive these days to the PMI data. So we've got a Spain services PMI number that has dipped to 53.3 in September from August's 5-month high of 54.3. That is the number on Spanish services PMI, a dip to 53.3. The headline from the institution that pulls together this data, Market, Spain's services sector grew at a slower pace in September, cooling from August's 5-month high as sales growth softened with signs of a spillover from a worsening contraction in industry. I think this is a very important issue as to what the contagion risk is into services from manufacturing and the industrial side of the economy, because I know the economists have a very lively debate about the likely impact. What's your read on this, Ben?
Yeah, but I think absolutely the services numbers are going to be very key to watch over the coming months. I think it's very clear. Look, we're in a manufacturing slowdown, and a lot of that is to do with the trade situation. I think also a lot of it is to do with this longer-term shift in the global economy. We're moving from a world where we buy stuff to a world where we buy services. You don't buy DVDs anymore; you stream it on Netflix, for example. But I think and at the moment, I think the consumer, the service sector can hold up the economy. As I've said before, the debt service ratios for consumers, particularly in the US, but around the world, is still very, very low. So consumers still have money. They can still go out and spend. It's still a sector of the economy that employs an awful lot of people, more so than the manufacturing side. So while those PMIs are still above 50 and not collapsing, then I'm still in a reasonably sort of confident situation that we're in a slowing economy, but not a collapsing economy. If they really start to fall and we really start to see sentiment hit and we see the non-manufacturing ISM fall a lot more this afternoon, then I think you've got to start reassessing. But at the moment, that's not our base case.
Okay, Ben, thank you very much indeed for that. To be honest, I thought the numbers would be better given how much we've all spent in Spain over the summer, but clearly that not helping.
Just your own personal expenditure.
Charlotte, thank you so much. We'll see you a little bit later on in programming. Here's a quick look at the European exchanges at the moment. As you look across these bourses, we're actually seeing quite a lot of green. Only the UK at the moment, which seems to be mired in reverse gear as we wait and watch the latest on this Brexit story. We'll see you in a moment. Stay with us.
The CNBC app has new features just for you.
You're in charge of hiring, and Indeed has solutions, like online skills tests, which let a candidate show that they are the right hire. And we give you this toy monkey, who will bang its symbols when the right CV appears on your desktop. Okay, there is no monkey. There is no monkey. But there are online skills tests.
See why more than 250,000 companies in the UK use Indeed for hiring. Visit Indeed.com/try today to try skills tests for free today. Terms and conditions apply.
Get ready for Brexit on the 31st of October. This means that travelling to the EU will change. You'll need to check online if your passport is valid for travel to Europe. If you're planning on driving, you'll need to check if you have the right documents to drive. And make sure your travel insurance covers all your healthcare needs. To keep your trip on track, check what you need to do at gov.uk/Brexit. Get ready for Brexit on the 31st of October.
At Argos, save 25% off homewares across thousands of lines. Our autumn-winter home and furniture collection is here. So stylish, you can wear it. With Argos, you're good to go. Offer ends 8th of October. Conditions apply. Subject to availability, selected lines.
The relaxing sound of fresh, cold running water. And you can have it in your kitchen. With amazing savings on Samsung fridge freezers at Currys PC World. Like the RB31 with its chilled water dispenser for only $3.99.